I gràcies per la seva assistència. Per segon any consecutiu tenim l'honor de comptar amb la presència a Andorra del senyor Robert Leininger, vicepresident de la companyia nord-americana GAMCO de serveis financers. Senyor Leininger, moltes gràcies per estar amb nosaltres una altra vegada i fer-nos arribar la seva experiència en directe sobre els mercats o el mercat nord-americà. GAMCO ha obtingut els reconeixements més destacats de la indústria de la gestió d'actius de forma continuada. Així doncs, per exemple, l'any 2011, el seu fundador va rebre el Premi Money Manager of the Year que atorga la revista institucional Investors. GAMCO també ha estat distingida per Morningstar en múltiples ocasions. D'altra banda, Standard & Poor's ha qualificat amb el rating Platinum, prèviament categoritzat com a rating AAA, el fons Star GAMCO Equity durant 9 anys consecutius. En quant al senyor Leininger, té una experiència de 25 anys en el món de la banca d'inversió. Tota la seva carrera professional ha estat lligada a inversions financeres. Actualment gestiona mandats i fons d'inversió dins de l'equip Value de la gestora. Està graduat cum laude per l'Amherst College i té un MBA per la Universitat de Pennsilvània. I també disposa del CFA. Bé, 5 anys després del començament de la crisi financera, l'economia nord-americana, en contraposició al que està passant possiblement a Europa, sembla estar en el bon camí perquè torni al seu creixement potencial. La política monetària i les mesures fiscals ultraexpansives que s'han dut a terme de manera agressiva des de l'inici de la recessió, i això és important, des de l'inici de la recessió, han permès donar l'impuls necessari per a una reactivació sostinguda de la seva economia. És a dir, possiblement en contraposició, que això ho veiem també l'any passat amb el senyor Leininger, el que ha passat a Europa, els Estats Units ha reaccionat de forma immediata i contundent a la crisi financera que possiblement va tenir el seu inici precisament als Estats Units. Per contra, a Europa, la diferència està en que no ha sigut ni immediata ni contundent. És a dir, no ha sigut tan contundent i ha sigut alguna més lax en el temps. I això possiblement marca també la diferència entre en quin punt estem ara en relació a la crisi tant als Estats Units com a Europa.
So again, we invest in the U.S. stock market and we run a portfolio with Crèdit Andorrà. And just thought I'd spend a little time putting the market in perspective for a little bit. So last year, again, we were talking about how the U.S. responded to the financial crisis. Here are just some numbers. The S&P 500, which is a good proxy for the overall U.S. stock market, at its peak back in the year 2007, declined 57% when it hit the bottom in 2009. So quite a large sell-off in the market. However, you can see the market has come back quite strongly, and in our opinion, a lot of that's because the U.S. did take very aggressive actions in terms of addressing the financial crisis. And you can see that from the bottom, the market went up 136%, and that's through April actually. As of today, it was up a couple more percent, so the market's continued to climb a little bit since the April 30th date we have here. So we have reached the peak and actually climbed a little bit above it. So we've come out of the worst of the financial crisis in terms of the stock market in the United States. The Russell 2000 is an index for small cap stocks. So this is just to point out it's not just the large cap stocks that have done well in the U.S. You can see small cap stocks were down 60% from the top to the bottom, and they have also come back nicely. So here's a snapshot of the United States, China, Japan, and the Eurozone. And you can see that in the U.S., real gross GDP, real gross domestic product, is growing fairly nicely at 2%, nowhere near how well China is doing right now, but we're happy with 2%, and we think that that should grow in the next few years going forward. Inflation, as represented by CPI, Consumer Price Index, is under control, just under 2%. And as you can see, our unemployment rate is 7.6%, and that is gradually coming down, as I mentioned before. This is just a quote from John Galbraith, who you may know. We at the Gabelli organization like the free enterprise system and like government letting business get to the business of business. So this is just a nice quote from him about how it's nice to not let government get in the way of business too often. So here are some of the negatives in terms of the U.S. economy, in terms of what's holding back the U.S. economy right now. We have recently raised taxes to help address the big budget deficit in the United States. So taxes this year went up, which is a little bit of a drag on the economy. Our federal government imposed a sequester, which was a mandatory cutback in discretionary federal spending that went along with some of the tax increases. Other events going on in the United States of America is the regulatory environment. Dodd-Frank refers to a new bill in the United States which adds an extra level of regulatory burden on the financial system. So it's uncertain how onerous that will be. And we also have a new healthcare approach going on in the United States called Obamacare, which is part of the government taking over a greater share of the healthcare system, and the cost and implementation of that program is still a little uncertain. We continue to have a rather large deficit at the federal government. It is getting a little bit smaller, but still it's quite large, and we do have a debt problem in the United States. And then Europe being slow also impacts the multinational companies in the US. So the US companies that operate in Europe are not really seeing any growth in that segment of their business right now. The monetary policy in the US and globally has been one of easing. So that has helped the US economy with interest rates going down. And as I mentioned before, we do have job growth going on in the United States. The construction industry is starting to come back. The private sector is starting to hire again. So that is going in the right direction. This is a chart that explains how the individual consumer is doing in the United States. This is financial obligations, meaning consumer credit and mortgage as a percent of a household income. As you can see, it's actually below the 30-year average. So over the last 30 years, about 12% of the American consumers' disposable income went to financial obligations. It has now come down to just over 10%. So an improvement versus the long-term trend. That has been for two factors. One, households have been paying down their debt, and also interest rates are at very low levels right now. Here we have a little comparison between what the Federal Reserve in America has been doing and what has been taking place in Europe. And you can see that the Federal Reserve has been growing their balance sheet just about up to the point where the European Bank has grown the balance sheet. And over the last 5 years, we have actually been more aggressive in growing the balance sheet of the central bank to 3.3 trillion. So this stock looks at how much stocks are owned by both individuals and large institutions, such as pension funds. Right now, the percent of the portfolio that they have invested in stocks is actually below what peak has been before and a little bit below what the average has been over many decades. So both institutions and individuals have a smaller percentage of their overall assets in the stock market right now in the US versus longer term trends. Another positive sign for the stock market, that there should be greater ownership. We think that stocks in the US stock market is an excellent asset class to be invested in. And over the long term, stocks have been the best way to build wealth over a long period of time and to preserve capital. This chart shows how well the stock market has done in not only keeping up with inflation, but clearly surpassing it. If one looks at a 35-year period, you can see earnings for the S&P 500 have grown at about 6.6%. When you add in dividends, the total return for the US market has grown at approximately 8% a year, compounded annually for 35 years. A little bit more than doubling the inflation rate in the United States of America. And if one goes back over 80 years, 90 years on long-term studies, the stock market has done just as well or even better in terms of growing wealth and preserving capital. It has been by far the best asset class to be in. So here I just want to talk a little bit more about the big picture in terms of the gross domestic product of the United States. You can see it's grown quite nicely. So in trillions of dollars, it's over $15 trillion. Exports are approximately 14% of the economy right now, which has grown nicely over the years. Imports have also grown, and imports are higher than our exports at 17% of the gross domestic product. So we currently have a trade deficit. This is opposed to our federal deficit on our budget. This is the trade deficit. We have a trade deficit in the last fiscal year. And that trade deficit has been fairly steady at about 3 or 4% over the last decade. We used to have almost no trade deficit back in the 70s and 80s. But we think that's going to change going forward. So the America has had a trade deficit for a while, but for a few reasons we think that's going to change. You can take the entire deficit that the U.S. has on a trade basis and point to two areas. We have it because we import an awful lot of oil still. The United States of America imports over $300 billion worth of oil on a net basis. We also have a big trade deficit with China because a lot of America's manufacturing industry has moved to China over the last few years because it was more cost competitive. We think both of those trends have already changed and are on a new trajectory that play on some of these themes. We just talked about how we think there is a game changer in the United States in terms of the energy market, that the United States of America will have a competitive advantage in terms of energy pricing, which will help the manufacturing sector in the United States also. But Consol Energy is one of the stocks in the portfolio that we run. They are based in Pittsburgh, Pennsylvania, and they own both coal fields and also land acreage in Marcellus where there is natural gas. So we're very attracted to this company given the large land holdings they own in the Marcellus region. They currently receive most of their income from coal, and because of that, many people think of it as just a coal company, but to us, the long-term benefit of the natural gas is what's really intriguing. When we look at a company, what we like to do is we like to establish what we believe is the private market value. The GAMCO organization, we're known for value investing, and we apply what we call private market value with a catalyst approach. We look at a company's stock and we decide what would this company be worth in the private market. If somebody were to come in and buy the whole company, how much would they pay for this company? If we can buy the stock at an attractive discount to that price, we become interested in that stock. So when we go through the valuation for Consol Energy, we think the coal assets are worth just over $6 billion. We think the natural gas assets are actually worth more. We think they're worth well over $7 billion. So adding those two pieces of the business together, we think the enterprise value of the company is approximately $13.8 billion. Then once you establish what you think the company is worth overall, you minus out what the debt holders would get. And when you take out the value of the debt, you come up with an equity value. So in our opinion, Consol Energy has an equity value of over $10 billion. And then divide that by number of shares outstanding. So we come to a private market value of about $45 per share, which we find very attractive.